So let's get underway, and thank you all for joining. What a large group. Maybe we missed the boat by putting a more seemingly mundane subject on the back burner, but here we are talking about long-term care. At its core, insurance is a contract, and the contract provides either financial protect. Dave, how's my volume?
Perfect.
All right. So the contract provides either financial protection against loss or reimbursement for losses. And by spreading the actuarial risk over a large pool of individuals or entities, the contract provides essentially financial leverage to purchase that protection for a small premium relative to what would be a large potential outlay, essentially creating discounted or guaranteed discounted dollars if the policy benefits were to pay out. So for example, in whole life insurance, which I own, a policy holder might pay over their lifetime a total premium no greater than $120,000 to have $1 million in tax-free death benefit, which translates to providing each dollar to your family for no more than 12 cents, which is a good value proposition in this case. And the leverage that comes from purchasing the life insurance is that I get that coverage from day one. On my very first premium, I have that $1 million. And it would otherwise take me roughly 30 years and probably 350,000, which is 3.5 times in contributions to grow the same pool of dollars for my family. And we don't even know that I can guarantee that this would be achieved. So when looking ahead at providing enough dollars to cover possible long-term care costs, we hope to find that same financial leverage through the use of long-term care insurance. But stepping back for a minute, this insurance value proposition, it varies among different types of insurance coverage. So health insurance provides health insurance involves a very high probability of paying benefits. So there's a relatively high premium, say $2,400 per month for a family. On the other hand, something like trip cancellation insurance involves a low probability of benefit. So there's a very low, cheap premium. Regardless, most absolutely necessary forms of insurance coverage have very accurate, long-standing actuarial outcomes, making it relatively easy to plan for and involving very stable premiums over time. This is not so much the case, at least up through now, in the world of long-term care coverage. First, there are many different levels of risk exposure for long-term care costs. There are many different forms of long-term care services, each with a different price tag. And of course, we have changing demographics. And unlike, say, permanent life insurance, we know that a meaningful percentage of long-term care policies that are put in force will not pay out a benefit. So consequently, long-term care insurance has been difficult to price, been difficult to understand, oftentimes difficult to own, and certainly difficult to plan for when you're dealing with limited resources. I mean, few of us are so well capitalized that we can buy long-term care coverage without any concern for what it takes away from other budget items. So, sometimes for me as a financial planner, from a suitability perspective, it almost seems rigged that those that can easily afford the coverage are closer to being self-insured. Yet those that need it the most have difficulty finding room for it in their budget. I myself am preparing to purchase long-term care insurance soon. And while I don't know yet how I'm going to design the coverage, I do know this. If you see long-term care as a product solution to cover 100% of your possible or estimated long-term care costs, it'll be so off-putting price-wise that you probably do nothing, which doesn't help. But if you look at long-term care coverage as essentially a copay, that along with your other income sources, the coverage will at least allow your invested assets not to be depleted at a threatening rate, then you'll find that the long-term care approach, long-term care insurance, makes a ton of sense. So our goal tonight is to, whoops, I thought somebody was trying to get, our goal tonight is to help you better understand the long-term care landscape at large, call it the why portion of the discussion. We're going to cover the policy design of various long-term care policies and the types of benefits of each. We'll call it the how portion, and different funding strategies that may allow long-term coverage to be both appropriate for you and affordable. And we'll call that the when portion. So we'll cover why, how, and when. To do this, we welcome Amy Lozier as our guest speaker. Amy is a senior long-term care consultant with Ash Brokerage. They are both the largest privately held insurance brokerage in the country, but they're also the group that we work with when we're trying to design long-term care policies for our clients. She's based out of Kansas City, and she's willing to join us tonight, even though she has 2 young adult sons that she has to take care of. Amy has 2 long-term care certifications. In the 2000s, she was a consultant with Accenture and Anderson Consulting. And since 2007, she's been a marketer and educator of long-term care insurance coverage. So with that, I introduce Amy. She'll go through her thoughts, and then we'll open it up to Q&A. And I am sure that she'll tell you, because it's the most efficient, that if you want to follow up on anything that she brings to your attention or anything that you're curious about, by all means, you can, well, I'll let her say this, but you can contact her through us or directly so that we can close the circle on your concerns for long-term care coverage. So, Amy, it's all yours.
And how am I doing on volume, Charlie and David?
Good.
Perfect.
Okay. Thank you for that introduction. As he indicated, I've been in long-term care insurance planning since 2007, and I support advisors around the country like Charlie and David who have clients interested in addressing long-term care planning as they do their, overall holistic planning. I guess I'd like to start with telling you what long-term care insurance is not. There are some misconceptions about long-term care insurance and long-term care planning. Basically, Medicare, people think Medicare covers long-term care events. And actually, that's a misconception. Medicare will assist with the payment of the first 20 days of skilled nursing care and some home care, but only when it's associated with a hospital stay, a 3-day qualified hospital stay. So I'll use an example of my grandpa Donnelly, who lived in Pittsburgh, where I'm from. He went down in the cellar, shouldn't have been there, fell, broke his hip. And so he had a hospital stay with Medicare and was moved for physical therapy over to a skilled nursing home. Medicare would cover the first 20 days of that care. But as you get towards day 100, where Medicare would stop, there's a higher and higher copay. So there is not extended skilled nursing care as a part of Medicare. If one goes home and has some physical therapy, there also can be up to 20 days of coverage and then becomes more highly deductible until day 100. People also talk about Medicaid as covering long-term care. Medicaid is available not for home care, but for skilled nursing care, but only to those who may be clinically qualify, but they also have to financially qualify. And so Medicaid would not be available to the vast majority of us because we have too much in the way of real estate and investment savings and income. So where does long-term care insurance kick in, or where is it appropriate? It is insurance that's available to you when you have an extended healthcare event that goes beyond that, say, 100 days that Medicare might cover. An extended healthcare event could be, anywhere from 100 days to lasting for years. My mentor in this industry, his mother-in-law, was physically quite healthy, but had an early onset Alzheimer's diagnosis. She spent 15 years in skilled nursing. So with a long-term care plan in place, there can be leverage that Charlie was describing, where you've paid a certain premium, but you have a much larger income stream that's able to come from the policy to pay your extended healthcare bills. So Medicare and Medicaid are available to people, but for either, in Medicare's case, a short period of time, or Medicaid, if you're financially eligible. You might approach Medicaid, but Medicaid will say, please, use your own resources until you reach a certain financial level where you'd qualify. Long-term care benefit plans basically provide a monthly income stream for you, whether you're residing at your own home, and the vast majority of us want to stay at home and have the care come to us. But long-term care plans also can provide a monthly income stream if you are in an adult daycare center. Until entering into this industry, I didn't even know adult daycare centers existed. But yes, a van could come to the house and pick you up at the beginning of the day and bring you back home, where you can be with your peer group receiving observation and care. So at home, adult daycare, certainly assisted living, skilled nursing home, and end-of-life hospice. So wherever one would need care, a long-term care policy can provide that income stream to help pay your long-term care bills. There's a lot of focus in the industry about nursing homes, and as if long-term care insurance is nursing home insurance. Although the earliest products, clear back into the 80s, were nursing home only plans, the carriers listened to consumers like ourselves who said, hey, we want to stay at home while we age. We want to be around our things and where our loved ones can come visit us, and around our neighbors. And so the carriers listened, and the products became more comprehensive so that you could have home care and assisted living and nursing homes. So although there's all the talk about long-term care being a way of funding nursing home needs, only 74% of claims are actually in skilled nursing. I found this surprising when I first entered the industry. Only 13% of claims are in skilled nursing, and 13% are in assisted living, but nearly 3/4 of people that receive benefits from their policies, it's at the house, care coming to them. We're accustomed to, on another, kind of statistic front, to help, maybe form an opinion that, hey, should I be exploring long-term care plans for my own household, or, who needs care? For people turning 65, 3/4 of us will need some form of extended health care. Again, whether at the house, assisted living, or in end-of-life hospice or skilled nursing, 3/4 of us. But 3/4 of us have no plan in place. Only about 25% of Americans have a policy in place where you're kind of partnering with the carrier to help, again, provide that monthly income stream to pay your bills. we're accustomed to insuring men in our society. Historically, men have been primary bread winners in families. And so we've been accustomed to insuring them for life insurance to make sure, kiddos go to college and the house is paid for and so forth. But when it comes to long-term care insurance, arguably women need it every bit as much or more than men. Partly this is due to a statistic. 75% of married men pass away still married with someone at home to care for them, to provide that informal care as they age. In sharp contrast, 75% of married women are predeceased by our husbands. And so women are, more exposed to being alone and needing care. Women do pay more for long-term care plans, but our claims tend to be later in life and longer than men by almost a full year. You might wonder about how much care people need. If you poke around on the internet, there's all, the talking heads that talk about 3 years as the average length of stay in a nursing home. But in actuality, if someone lives a year in a nursing home, the average length of stay is 4 years, a little bit shorter for men, but the average length of stay is 4 years. And so when we think about self-funding a long-term care risk, we can be signing ourselves up for a great deal out of pocket. So whether someone puts an insurance plan in place or not, it's a good idea to visit with people like Charlie and Dave and look at if you are going to self-fund of your investments, what would you want to cash in first, next, and last, should an event occur. But if you put a plan in place, as Charlie indicated, not everyone puts a plan in place that's going to cover all of a nursing home or all of assisted living or home care. But even having part of a long-term care event insured, you're reaching into your pocket to self-fund after your insurance carrier partner has paid its portion. In Connecticut, I did some inquiries, and the average cost per month of home care today in your area is $5,300 a month per person. Assisted living on average is a little bit less. These are median care costs, around $5,100 a month. Skilled nursing can go anywhere from $14,000, $15,000 up to $20,000 per person per month. Now that upper end is shocking, but that's more of your memory care unit where you've got increased staff and extra security to keep people from leaving the facility, what have you. But so anywhere from $5,300 to $15,000 a month per person at today's rates. Care costs have been going up about 3% a year. And so when we look at crafting plans, we sometimes look to add a growth rider so that the kind of bucket of benefits you have and that monthly income, that ladle, so to speak, to pay your care bills, we oftentimes quote a growth rider so that that bucket of benefits and that monthly ladle to pay your bills gets larger to keep up with increasing care costs. Care costs could double in the next 20 to 25 years. So these statistics I cite are shocking. Statistics don't, don't motivate people to buy, but my goal with providing some of these numbers is just to give you an idea of, care costs in your area and duration of care, and that Medicare and Medicaid may not be those public systems in place that you think might be there as a safety net for you. what I'd like to do next, and that was kind of the why aspect. Why might you want to consider visiting about whether to put a long-term care plan in place, or whether to, create a list of your investments and what you would like to kind of cash in first, next, and last to fund a plan. But on the how do some of these long-term care products work? There's basically two types. And I always use a sort of primitive bucket and ladle sort of a way of describing them. With a traditional long-term care policy, basically it does one thing and it does it well and at a lower price. Basically, there is a dollar amount, an initial value of the policy, and then there's a monthly benefit. And again, thinking of that as kind of a bucket and a ladle. And that ladle would represent the amount that your plan could pay out each month to pay towards your care bills. Traditional long-term care products have largely just a recurring premium, something that you would pay each month or each year, during the life of the policy, and those premiums are waived at the time you go on claim. There are a few carriers that let you pay, once and done. You have that premium behind you and the plan is fully paid and in force. And a few carriers have where there can be a 10-year premium. These kinds of products have merit discounts, some of them even if only one partner is buying. Maybe that other partner already has a plan in place, something that you got through work, or maybe one of your partners is already on some sort of disability or is not of insurable health. But there are married and preferred health discounts available with these policies. The benefits that are paid out each month against your nursing home or home health care bills, that's a tax-free benefit, and the premium is tax qualified. And that can be attractive to some business owners where all or part of the premium can be paid by the business.
And therefore tax deductible
Yes.
to a limit.
Exactly right. And so those are traditional policies. Again, you've got sort of a bucket of benefits and a ladle. They can be designed to last anywhere from 2 years, 3, 4, 5. There are a few carriers that have longer, even bottomless buckets of benefits. But most people that put plans in place, purchase a plan that's expected to last 3, 4, or 5 years. Another type of product that's available and becoming increasingly popular over the last 20 or 25 years are called hybrid plans or combo plans. And what basically you have there is a life insurance policy that also has a long-term care rider. Where some of these products can be attractive are to the people that don't like it that with the traditional policies, if you don't need long-term care, you've had the peace of mind of having that policy in place. But it's not as though if you don't need long-term care, the carrier is going to chase after you and refund your premium. It's just like traditional plans are just like your homeowner's insurance, where I don't expect USAA to refund my homeowner's insurance if my house doesn't catch on fire. Same thing with long-term care insurance, the traditional plans. It is kind of a use it or lose it premium. But
So sorry to interrupt. So if you have some kind of financial windfall where you want to stop the policy or you pass away abruptly such that you don't need long-term care, there's no return of premium.
That's exactly right.
And for those people that are scared by the proposition of use it or lose it, the hybrid policy has a way to make sure you get some return of capital.
Exactly.
Okay. Sorry.
So with these hybrid plans, you basically have kind of two buckets of benefits. You've got your death benefit and a long-term care rider. And these products it's a guaranteed premium. And to put it crudely, they have live, die, or quit benefits. And by that, I mean the living benefit is long-term care. The die part of that is if you don't need any or much long-term care, you'd have a death benefit. And the quit aspect of it is these hybrid plans have a cash value, so that if you wanted to walk from the plan, foregoing the larger long-term care and death benefits, you'd have a modest surrender value, like a quit or a return of some of your premium value. So the hybrid plans have death and long-term care benefits. You can think of them as having kind of two buckets. If you pass away, you just have the death benefit bucket. But if you need long-term care with these hybrid products, first you use the death benefit bucket early. You use it as a living benefit. And then there's a long-term care rider bucket of equal size, at least equal size, for more long-term care. So these hybrid plans can be attractive because we have premium guarantee, and no matter what your future holds, live, die, or quit, your policy is going to work for you. These hybrid plans can be funded in an increasingly wide variety of ways. You can plunk down a single, lump sum premium, or maybe have a cash premium that's spread over 5 years, 10 years, 20 years. You can also fund these life long-term care hybrid plans with money that you're transferring from other places. In a tax-free exchange, you could take life cash value, maybe from a death benefit policy you no longer need. The house is paid for, the kiddos are educated. So maybe you take that, that cash value from your whole life policy or a universal life policy, and you take it over in a tax-free exchange to fund the life long-term care hybrid. So we can do that type of exchange. We can take non-qualified annuities, 401k plans, 403b plans, if any of you are teachers or retired teachers, to fund a hybrid plan in that way. And some people fund their plans in a combination of ways. Maybe I have 26,000 in life cash value with a policy I no longer need. But maybe when I go to run that premium, it doesn't have as robust a long-term care benefit as I want. So maybe I transfer in that 26,000 in life cash surrender value, but then I maybe pay 5,000 a year in a cash premium over the next 5 years. And together that cash and that cash surrender value come up with sufficient premium where I'm happy that with the level of long-term care benefit that I have. And if I don't need the policy for long-term care, upon death, my sons would receive the death benefit. So again, traditional plans where you have most likely a recurring premium of a lower amount for just a plan that's going to give an income stream for home or facility care, or with the hybrid plans, maybe a larger premium, but one where there is death and long-term care and a wider variety to fund them. But when rubber hits the road, when one needs long-term care, these plans are going to function in the same fashion, in that you've got, a 3, 4, 5, or 6 year benefit period for long-term care, and you've got, that monthly income from the policy. So they'll function the same way. They'll support you with that monthly income stream for long-term care in the same way. It's just the hybrid plan is going to have additional ways where you can benefit from the policy with death or cash value. These plans can last longer than they show on paper. Maybe I've got a 4-year plan, but my care costs are low. So a plan can last longer. It just depends on whether you take that full monthly benefit out of the policy or not. Like most insurance products, there is a deductible. The industry standard is 90 days. And what that means is if as soon as you have a memory issue or the inability to kind of independently manage your life, like in the case with my father, he needs a walker as he moves throughout his house, and he's been a fall risk in the shower. And so my dad's policy benefits were triggered that way. But first, my father needed to self-fund his first 90 days of care. So basically, as soon as you're clinically able to start receiving income from your policy, you've got to self-fund the first 90 days or 3 months. At that time, then the policy will begin paying out that monthly benefit. So there is a deductible. With some of these hybrid plans, the deductibles can even be, 0 day, meaning no deductible at all. Some of these hybrid plans have 1 and 2 month deductibles, but in general, the industry standard is self-funding the first 3 months of care, and then your policy kicks in. And I should go back on, like, how does one start receiving benefits? Basically, there's 2 ways. One is like the case with my mother, and my mother and dad both bought policies before I was even in this industry working with their financial advisor. My mother triggered her benefits with memory issues, started out leaving the chocolate chips out of the chocolate chip cake, and then became, more serious, her memory loss. So if one has cognitive or memory issues, either from the aging process, Alzheimer's, dementia, a stroke, an auto accident, issues with the brain can trigger one's benefit, so that carrier partner begins paying out towards your care bills. In the case of my dad, it is, there are things called activities of daily living, things that we all kind of take for granted. In the morning, we roll out of bed, we move around in our house. We hold our bladders till we get to the bathroom. We manage ourselves in the bathroom with showering. We get dressed and we feed ourselves. These activities of daily living we take for granted. We're independent. We don't really even think about it. But as part of the aging process or disease or a stroke or an auto accident, things that aren't pleasant to think about, we can lose that independence. Dad needs someone to be there as what they call standby shower assistants. My mother needed assistance making sure she ate and took her meds, things of that nature. So basically, a physician would indicate that you've got an Alzheimer's dementia diagnosis, or you have the inability to manage at least 2 of 6 of those activities of daily living. People who purchase these plans most often are anywhere from 40 to close to 70. We do have some products that will go up even to age 85. Some of the annuity chassis products and whole life and universal life hybrid products can go up to upper ages. But a lot of the consumers, I'm 60, people in their 60s, early 70s are big consumers of these products. Like insurance products having deductibles, insurance products also have underwriting. You need to be of an insurable age, 40 to 85. There is underwriting involved. Ideally, if you explore a long-term care product with Charlie and David, we would want to look at what medications you're taking, maybe what surgeries or physical therapies you've had. Have you had any joint replacements? Tobacco, build. So we try to look, before you apply for a product, we try to look at your health and make sure that, one, we're approaching a carrier who's receptive to insuring you with your health conditions. And also we want to be quoting the most likely underwriting class. Like I'm, a non-tobacco, but somebody may, enjoy that Sunday cigar and has hypertension medication, so there are different underwriting classes depending on our health. So it's always a good idea to visit with your advisor about your health history so that, again, we can be approaching a carrier who's receptive to insuring you, and we're quoting at the most likely underwriting class. What is your underwriting experience if you decide to apply for a plan? You'd answer some health questions on a policy application form, and then a nurse underwriter would contact you by phone, or if you're over age 64, that nurse underwriter would come to the house. In this day and age, that person's going to be masked and vaccinated and keeping at a distance, gloves, what have you. But someone would come to the house if you're over 64 and interview you. And there may be a few memory questions in the interview, like, Amy, name 5 brands of cars. And then we go on talking about my weight or my health history. And then maybe 10, 15 minutes later, the nurse may say, Amy, remember you gave me the names of 5 cars. Can you list those car brands again? So that sort of level of memory questions. Then that nurse underwriter is going to determine, based on your conversation and the health information you listed on the policy application form, and they're going to determine what medical records to go seek and review. The carrier then makes an underwriting decision to say, okay, we're going to approve Amy at preferred non-tobacco rates. So there is health underwriting, and it varies by age. If you're 45 and applying, that interview would be over the telephone. If you're 65, with most products, a nurse is going to come to the house and interview you in your own environment. Okay. If you're interested in exploring long-term care planning with Charlie and David, it is, I believe, helpful to share with them about your parents. When I'm visiting with clients, I will ask, tell me about your parents. How old are they? Where do they live? Who cares for them? Who pays for that care? And so if you have that conversation with your advisor, they can learn a great deal about whether your parents had a plan in place, whether your family's interested in caring for one another, or whether you're like my folks, where home instead, so people come from an agency to the house. Some plans will pay friends and family. Those are cash plans where you could hire, your adult granddaughter who needs a job and is home for the summer, or a plan could pay a home health care agency. But when you visit about your family's experience with extended healthcare events, you can help inform your advisor as to maybe what you envision for yourself. And by talking, aloud about your family's experience with long-term care, it can help you determine how important it is, this risk for you. Do you perceive the risk pertaining to you? And do you want to put a plan in place with a carrier to at least get some leverage from partnering with a carrier? Or do you want to just write down a list of what financial investments you would use to pay for an event should it occur? But sharing again about your family can be quite informative in deciding what type of plan you may want for yourself. Most of us don't put a plan in place for ourselves, but we put plans in place for our loved ones. My dad is a smart aleck and would say, oh, just put me out with Thursday's trash. My mother, being more sentimental, is like, no, wait a minute, we need to have a plan in place so that we're not turning our adult children into care providers. We want a plan in place so we can protect assets, and we want to stay at home while we age. Having a conversation about long-term care planning, even if you decide not to put a plan in place, you've had the conversation and your plan is either to self-fund or to partner with a carrier and get some leverage from that. As we mentioned earlier, the long-term care benefits that would be paid out from your plan are available to you tax-free. And plans are designed to provide that income to you wherever you need the care, whether it's care coming to the house or in skilled nursing or assisted living. If your plan doesn't provide sufficient income to cover all of your long-term care bills, it would be just like when we go to the doctor's office. You can give your care providers permission to bill your insurance company directly. Your insurance company will pay your monthly benefit against those care bills, and you would see a balance due for any gap between that care bill and the monthly income from your policy. The average claim age is 79 in the United States. Some carriers will say 78, some up to 81. But the average number, the average age of people who need benefits is 79 here in the United States. I'm open for questions from you, Charlie and David, or from attendees if you'd like.
Yeah, I mean, I'll just start off quickly, two quick things. So what are the conditions by which you can transfer some of your 401k to fund a long-term care? In other words, if you were fortunate enough to have a somewhat overfunded 401k, you could do something equivalent to a 1035 exchange to get a certain amount of dollars in there to help the cause. Are there any parameters that we should know about, or is that just enough to know?
Actually, there is. Uncle Sam gets paid one way or another. And so, those 401k and 403b plans are untaxed dollars. And so we can basically take those funds, those qualified funds, and purchase an annuity in that lump sum, one carrier paying another, kind of a rob Peter, pay Paul. And then over 10 years, you can receive 1099s as that annuity is sort of empties itself, paying the long-term care hybrid plan.
Got it.
So we can use those qualified dollars. Uncle Sam still needs to be paid. So rather than cashing in and having a larger tax implication, you can spread that taxation out over 10 years, 10 1099s, and pay for your hybrid lifelong
Well,
care
that
plan
helps
that
me
way.
if we have any other conversation. The second quick thing is, in our efforts to try to come up with a policy design that fits a particular budget, there are things that influence the premium. And it's just a matter of tweaking those influences to arrive at the right premium and the right policy construction. So if I quickly list them, I would ask you if there are any others that I'm not listing. So you have the dollar amount of the benefit, the length of that deductible, the length of the benefit payout. You have the degree to which you want home health care equivalent or not equivalent to nursing home care, assisted living care. You have the degree of an inflation rider that you're going to pick, and you can customize the degree of that inflation rider or that growth rider, as you called it. Are there any other tweakers that we can adjust to try to come up with a reasonable premium?
Well, preferred health and married discounts can lower the premium. A rider that can be added in addition to the growth riders, and we recommend the growth riders for younger consumers where there's maybe, knock wood, a delay between when they put the plan in place and when they might need it. But a rider that can be attractive to married couples is something called a shared rider. And what that is if you kind of picture yourselves, like I see Rebecca and husband sitting there. If you're a married couple, picture yourself sitting at a table, each with a bucket of benefits in front of you. Let's say it's a 4-year plan that you each have, and you've got that ladle, that monthly income. With a shared rider, Rebecca, I'm going to pick on you because I can see your name on the screen. Let's say Rebecca goes on claim and she ladles out over 4 years. Each month she's got, 4, 5, 6,000 a month coming out of her policy to pay her long-term care bills. But let's say it's the end of 4 years and she still needs care. Well, there's her husband sitting over there with a 4-year bucket of his own. With the shared rider, picture her swinging her ladle out from her empty bucket over into her husband's bucket. And with that shared rider, you could start ladling out your husband's benefits.
They do that with cake at dinner also, so just so you know.
Yeah. But it's a shared rider. So it's a way of maybe purchasing a shorter plan, right? A smaller bucket. But then if you run out of benefits, one of you needs more care than is available in your own policy, with a shared rider you can take from your partner. Now you might say, well, don't I want to keep that other policy there for my husband? Well, what if your husband's like my grandma Edie and he just surprises the heck out of everybody and he just doesn't wake up one morning? So you don't want to save that bucket for him. If you need it, use it. Now, some of these plans will maybe they'll keep a year in the bucket for your husband in case he needs it. But a shared rider, to answer your question, is one that can be attractive to marrieds both buying.
Right. Last question, and I'll shut up, I promise. So above the health rating level, are there any discounts for someone who can run a 10K? Just that if your blood pressure is below a certain amount, you get an extra discount?
Largely, no. There are preferred health discounts, with the traditional policies, and that's maybe somebody who takes no meds, has had no surgeries, or maybe something mild like asthma that flares up and you have an inhaler. But there are preferred health discounts, and then where most of us fall, some carriers are going to have like a substandard price, which actually is more expensive if you're of lesser health. But unlike life insurance, there aren't so many shades of gray underwriting. You're basically single or married, you're in or you're out with a lot of the hybrid products. So whether you're like me, a no meds, a little bit overweight, non-tobacco, or whether I could run, a marathon, I'm still going to probably just get a preferred rate for a policy. There aren't ultra levels of preferred with long-term care.
Okay. Well, anybody else?
See, Rebecca should pick on me with the question since I picked on her. Not to put anybody on the spot.
Well, you're explaining it so clearly. I don't have anything left to explain.
Well, I'm a big believer in this. Again, I spent, my first 20 some years of my career in, healthcare information systems, and only entered into insurance of this nature in 2007. But I've seen it work. Both of my parents ended up on claim with policies they put in place, years ago. Mom passed away on claim after 3 years. They had a shared rider. They owned 2 5-year plans. So when my mother passed, having only used 3 years, my dad inherited 2 years of her plan. Dad's in finishing up claim year 5 at 89 and still kicking it. And so he's got 2 more years he inherited from my mom. My dad's brother just went on claim about a year ago for Alzheimer's, and they all had the same goal: stay at home, protect assets. So I believe in the need. Most of us don't fully insure at nursing home levels. I contend that with all of us baby boomers, I'm 60, guess I'm the last of the baby boomers kind of marching through this system. Places are increasingly having wait lists. I believe as we approach home healthcare agencies or assisted living or skilled nursing, whatever our need is, to be able to say we have private insurance, I think can make us increasingly attractive to those increasingly limited providers of care. I have a plan in place. Mine would not fully address the risk. My plan is to purchase a hybrid and sort of have those two plans working in concert together after I get my next kiddo out of college next May. But a lot of us put a plan in place to at least address part of the risk to get some leverage. Again, I believe in the need. I've got some personal bias and professional bias that's developed over the years.
Amy, can you address, does this plan cover if you end up going to another country, for example? I'm a dual citizen, so I could retire in Canada and my US dollar would stretch so much further. So would this plan cover in Canada care?
That's a great question. You said you're dual citizen.
Yeah.
If you've got a permanent visa, like a green card, or you're a US citizen, these products that I've been describing are available to you. Most of the plans are available to United States, US territories, and Canada. So, having that conversation would be a smart thing. Some products are going to have better international benefits than others, but that's the sort of thing that, Charlie and Dave can learn from you in a conversation to say, oh, share that with Amy, and then we'll be able to look at products that have the best benefits for someone who might be an expat living in Canada. A lot of the products have limited nursing home benefits if you're out of the country. Maybe you're on, your 40th wedding anniversary trip in Tuscany, and God forbid there's a minor stroke. You would have, say, a year's worth of nursing home benefits for use in Italy, but you may want to make your way home to use the balance of your care. But all of these are going to have some modest international benefits. But for Canada, you'd be in great shape to be on either side of the border. For most of the products in our portfolio. And by the way, we're not in bed with any particular carrier, but rather we have a vetted portfolio of traditional long-term care products and these hybrid products that have life insurance or annuity chassis and long-term care riders. And we vet those products, the financial ratings of the carrier, how experienced they are, and how well they treat their claimants. So we can look at a variety of products, ask questions of you, learn from you, and select the right carrier or carriers to present for your consideration.
Any other questions for?
Actually, I have a question. Sorry, Charlie.
Yeah.
What about premium protection? You keep hearing these horror stories about how people's long-term care premiums start off at a reasonable level, and then, as the insurers become more aware of how many their costs, et cetera, they seem to go through the roof. Is that true or not true? And can you get premium protection of some sort?
That's a great question. Products purchased, these traditional long-term care products purchased before 2013 were underpriced. Carriers had less claims data. When they first priced products, carriers thought people would lapse their products, meaning that they'd pay in premiums for a couple of years and then quit. And the carrier's sitting there with those premiums paid in, but not having to pay out any benefits. But people did not lapse policies. Carriers years ago used to charge the same prices for men as for women. And they learned the hard way. We women tend to go on claim later in life and for longer periods of time than men. And so after 2013, the industry now charges more for women for long-term care benefit products. Then the third kind of mistakes carriers made when they priced prior to 2013 was they did not expect this low interest rate economy to last this long.
Yeah.
Carriers thought they'd bring in these premiums from people, they'd invest the premiums and they'd grow and have these, incredible cash reserves to pay on future claims. Well, this low interest rate economy remained. And so people who purchased plans in the 80s, 90s, and early 2000s, many of them have seen a rate increase, maybe even more than one. It's not as though the prices go up every year like our health insurance or homeowners insurance, but rather the carriers can go to your state Department of Insurance and say, this is the business case of why we need to increase premiums for people who own these XYZ policies purchased in the 80s. But carrier products purchased after 2013 had more informed pricing. They were able to look back at 30 years of claims data, and the prices are higher, but they are more stable. These hybrid products have guarantees. The prices cannot go up. And oftentimes, if you have an in-force policy, make that policy available to Charles and David, because I can analyze those policies and look at the strength of the benefits you have. And if the premium has become uncomfortable for someone, I can look at the benefits and determine where maybe we can dial back the benefits, get that premium back to a more comfortable level, but still leave you with some decent benefits to pay on those future care bills. Oftentimes, when we look at policies that are in force, they have, even though they may have seen a 7% increase or 12% price increase, they're paying far less than they would pay had they waited and were going to buy now. Sometimes when I analyze in-force policies, the premium will be 2, 3, 4 times what they're paying if they were to buy at their current age and health and in today's market. So just in summary, only the traditional plans could potentially see an in-force rate increase, but products purchased today should have a fourth the odds of an increase in the life of the policy compared to plans purchased in the 80s and 90s. And when we analyze those plans, most people, hug their advisor that they bought when they did, because then they become aware of the product prices are higher today because interest rates are so low. Great question.
Well, if anybody wants to follow up on this, you can schedule Dave, send us an email. We can connect you with Amy and or her expertise through illustrations and quotes. And we have some of our own creative ways to rig up the funding of these things so we can run that as well. So Amy, thank you so much. I'm going to stick around, as I mentioned twice, but thank you, and let you get back to your 2 sons who are probably wrecking the kitchen right about now.
Eating a meal.
Yeah.
Well, people, thank you so much for your time today. I'm grateful for the opportunity to educate about long-term care planning.